If you expect the U.S. economy to land softly, you then also have to ask, land softly to what? August isn't always just about taking time off and heading to the beach. It's also about gearing up for September's investment opportunities. CIO has a handful of some of these key initiatives that you can be focusing on today. A conversation well worth your time right here on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm your host, Anthony Pastore. I am here in the studio with Jason Draho, and we're joined by Justin Waring, remotely streaming in to break down some of the latest views from the CIO. So, gentlemen, really good to have you. Jason, I want to start with you. There were some changes made in the recent House View publication, which taps into our messages and focus. And in there, CIO upgraded equities to neutral. What was the rationale for doing that, especially right now?
Well, if I distill it down to the core principle, our view on the economy has improved. We thought before the economy would be on the cusp of a recession. Now we think a recession in the next 12 months is unlikely. It's not part of our base case. So if you're less pessimistic on the economy, less pessimistic on growth slowing down, a little bit more optimistic therefore on the earnings outlook, therefore we don't see a reason for equities to kind of really underperform. As a result of this change, we've also upgraded our price targets for both December and June of next year. So, for instance, our price target for June of next year has gone from 4,400 on the S&P to 4,700. Given the current market level, that's about a 7% upside. So we see kind of modest upside in our base case, hence the justification for going to neutral at this point in time. So it really is a macro picture that looks much better than we anticipated a few months ago, even certainly at the start of the year. Don't see a lot of downside risk to the economy in the very near term and even over the next 12 months. If that's the case, it's hard to be kind of too negative on equities, even if we don't see a huge upside. So I think that's the key component of the change. And you mentioned just messages and focus. Like one of the things we've been saying for 2 months is kind of look for the laggards in the market.
That's right.
That hasn't really changed. So we see now a little bit more upside for the markets overall, but it's really going to be led by, we think, those parts of the market that still year to date have been the underperformance. So that key message hasn't changed. It's almost like on an absolute basis, everything has shifted a little bit higher.
That's good. And then switching from equities to the fixed income side, if you look at things like the long end of the curves, 10-year treasuries, 30-year, their interest rates have really risen, and now investors are maybe even expecting they could go higher than where they are now. What's the CIO's view right there, and how much of that taps into expectations for what the Fed is going to be doing?
The biggest story in the markets for the past month is the rise in rates you've alluded to. The 10-year treasury yield, the 30-year treasury yield, up 50, 60 basis points in just over a month. What's driving it? Some technical factors. We're getting more supply than expected on treasuries. At the same time, you've seen central banks wanting to pull back. So just a bit of supply-demand imbalance.
Right.
There's also, though, going back to the first point about the economy looking better, the market's expectations for the Fed cutting rates next year and beyond have gone down, meaning kind of higher for longer is really being sort of reflected in rates. That's the fundamental story, is also why those rates, those 10-year yield, 30-year yield, are kind of going higher. Now, that said, we also do think ultimately higher rates bite and they're going to slow the economy. So we don't expect a recession. We expect a softish landing. It's not Goldilocks. Growth should slow. Inflation should continue to come down. With that, we think rates are going to go lower as the year, as we move towards year end. That's sort of why our kind of most preferred asset class remains bonds. It's also why we say still invest in quality bonds. If you can buy, a 10-year at 4.7% or high quality corporate bonds, municipal bonds at higher yields, that's a pretty attractive investment right now.
And recession risk still remains at a low level at this point. That hasn't changed, right?
It's at a low level. Not negligible, certainly. I think that the issue is, given the strength we're seeing in the consumer and the labor market, given the economic momentum we're seeing and the possibility of things like manufacturing could start to recover later this year, the likelihood of a recession starting in the next 6 months looks pretty low. What's the uncertainty really kind of kicks in, and what's the long and variable lags of monetary policy? But even there, given sort of the dynamics of the economy, we think it's more likely than not, it's still growing, essentially 12 months from now.
Terrific. Jason, thank you. Justin, let me bring you in here. Good to see you, by the way. And look, we're talking about the Fed, right, and the rate hikes that we've been experiencing. But if you look at it from sort of just a simplification tool, I can get a yield of about 5% by investing in something as simple as a savings account, which hasn't been the case for over 20-something years now. So why would I maybe want to purchase bonds that offer a potentially lower yield here?
Yeah, it's an excellent question, Anthony. And as Jason said, we've had a very attractive rise in interest rates that gives us pretty good yield opportunities across the yield curve, regardless of how long a bond you're buying. The yield curve is slightly inverted, so you're getting a slightly higher yield on cash and savings accounts than you might if you lock up in a bond for 2 years or 3 years. But we do expect yields to fall from here. And when yields fall, that is a tailwind to bond returns because you have duration risk, which influences the price of a bond. The price of the bond will increase as yields go down, but that tailwind will not take place for cash or savings accounts. All you're going to do is get a lower yield on those investments. And so if you have short-term spending needs where you can't stick with a longer-term bond, that's going to give you the highest potential return for your holding period. But other than that, you would want to diversify across the yield curve to take advantage of the higher yields across the curve.
Terrific, Justin. I know something that you and I have said in many shows like this in the past is it's time in the market, not timing the market. But what if I'm somebody who needs to spend, maybe be liquidated, spend money in the next few years? What if I have spending needs coming up? What do I do now?
Yeah, and I think that's a very important distinction. If you have spending needs that need to come from your portfolio in the next 3 to 5 years, this is what we call the danger zone. This is where bear markets happen. This is where recessions cause a big drop in stock market valuations. Stocks are still about 10% below their last all-time high, but it could be a lot worse if you put money to work today and then end up needing it in the middle of a recession or in the middle of a bear market. You could be forced to lock in otherwise temporary losses and miss out on some of the upside. So we recommend taking that part of your portfolio and separating it from longer-term investments. Your longer-term investments can own longer-term bonds and stock allocation. It's important to be diversified and have a balanced approach. But for the cash that you need in the next 3 to 5 years, we're getting very attractive yields on savings account. You can build a bond ladder that is pretty attractive. What we really want to focus on is high-quality bonds that match your holding period, your time horizon, so that you're not forced to sell at a loss during a drawdown.
Justin, great. Thank you very much. And yeah, as we were talking about with Jason here just a second ago, there are some opportunities in the equity markets. Obviously, quality bonds certainly can give you income. So thanks for bringing us through that. Jason, as we wrap up here, we've got about 30 seconds or so. What's maybe one takeaway that you could share with investors today from the new House View that just came out that maybe they want to, you want them to really think about as they walk away from watching the show today?
Look, I think we've kind of transitioned from an environment where investors were really obsessed with will we get a recession or not, to now starting to think about the long term. And you're seeing that's partly what's driving interest rates higher. The view that maybe longer term, like kind of growth will be the better than expected, rates will be higher than expected. So I think that's a reminder for investors to think about the long term, kind of following on Justin's comments, that reinvestment risk, to manage that if rates do decline because there's a recession, extending out and sort of getting that sort of barbell in your portfolio to provide some of those protection. But also in a macro environment that could play out, it's also making sure that you're again diversifying equities. We've seen a lot of people want to concentrate in tech stocks and growth stocks. We've preferred value, even we like an equal weight index for equities. So again, these are opportunities long term that if this macro environment plays out as the market's now thinking, those are the areas that we think are going to outperform.
Terrific. Jason, thank you very much. Let me thank you, Jason Draho, also to Justin Waring. Justin, thanks for being here. Always great to have you join the show, and thanks for taking us through, gentlemen. And what I want to also tell our audience is we're kind of referring to the latest CIO House View here at UBS. It's called When Elephants Dance. If you're wondering what that means, there's an explanation of it right on the second page of the report from our global CIO, Mark Halfley. So I would take a look at that and read it. If you want a copy, you can always call your financial advisor or reach out to them or visit our website at ubs.com/views. Lots of other great UBS and CIO content is there. You can also find other great content on our social media platforms, particularly Instagram. Follow us at UBS Trending for content that you won't find anywhere else. We're also on LinkedIn, Facebook, and Twitter or X. And as always, if you have any questions, remember, contact your financial advisor, especially when it comes to your portfolio. Until next time, I'm Anthony Pastore. Have a great day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.